And there we go. Thank you very much. And you should be able to see the calendar in front. I'm going to have a look at the economic calendar. I'm sorry about all these ads. This is ridiculous. But anyway, good, everyone. And thank you very much for joining me. So it's Sunday morning on my side. It's 10 a.m. And good. So I'm actually going to be doing my weekly analysis with you guys, and then I'm gonna I'll go ahead and apply that to my my week coming out. Just want to double check also that I got the dates correct. So it's from Monday the 8th until Friday. I'm going to Jamaica this week for the very first time. My fiance, she got a work thing, and so I've never been. So we're going to Jamaica, and I've just come back from Bali. We're going to Jamaica for a week, so we leave on Tuesday. So I'm not going to do too much trading this coming week, but let's have a look and see what's going on. First of all, we've got the Royal Bank of New Zealand's interest rate decision. It's probably going to stay the same. There was some incredibly good analysis in the Telegram group. I'm not sure how many of you are privy to that, but essentially saying that yes, the New Zealand economy is struggling a little bit at the moment. But they're probably going to be very reluctant to lower the rates because inflation is still a problem. So let's very quickly talk about what is the purpose of a rate hike versus a rate cut. Okay, so historically, and this is very much the case, the primary reason for rate hikes from the central banks of any country is to combat inflation. So when a market has become too popular, when stocks and companies are doing too well and prices are going too high and the cost of living has become too expensive, and it's starting to separate too much from the income that people from earnings, what people are making, then they usually start to dial up the interest rates to curb that, to curb lending and to ideally curb spending as well. So they use that to combat inflation. They reduce or they do rate cuts to stimulate the economy. So if you look at the US right now, the fact is that not all of the inflation, and this is a global problem as well, not all of the inflation has come down. It seems to be, and I can't speak for New Zealand, but it seems to be exclusively to do with corporate price hikes. Corporations are announcing record profits. They've never made as much money as they have now. And some of them have increased their product pricings by as much as 100% since COVID. They've almost doubled their product pricings. Not all of them, but most of them have seen at least an 84% increase in pricing. They've also done shrinkflation, so they've shrunk the size of the products that you get, the value in the bags, and increased pricing, which is insane. And so what that does is that actually impacts people's, savings. So during COVID, people they didn't travel as much. Some people have actually done quite well with regards to employment. So they've created savings, and corporations have worked this out, and they're actually starting to just charge more for basic stuff. So the other day we did a shop and it was £190, whereas I believe, I'm going from memory here, I'm pretty sure it would have been about £90 3-4 years ago. So corporate greed is really one of the primary drivers of inflation right now. It's a global problem. And the only way that that's going to come down is ultimately when it wipes out people's savings that they've accumulated since COVID, and then people just start cutting back and then they start doing it. Alternatively, there has to be some sort of regulation, sort of oversight from the government saying there appears to be price gouging here and we've got to kind of pull that stuff back in, which has happened in the past. So I do think it's something that's going to happen again. So the reason I bring this up is I think that they're going to be unlikely to make a change there, but that usually involves, there will still likely be some volatility in the markets at that time. I'm going on Singapore times here, so I've changed the clocks here to Singapore, so that'll be 10 a.m. For me, it's usually middle of the night kind of thing. And then we've got, out of the US, we've got CPI data, we've got crude oil. Crude oil is starting to climb a bit. We'll see what's going on with that, but the US economy is doing incredibly well. So we don't have to worry about the US economy. It's doing incredibly well. FOMC minutes, basically, if anything, there's a possibility of a rate hike. If they feel they can't get this inflation, if they can't, I feel what they should do is specifically target corporations. I feel like they should do that, but they might maybe threaten a rate hike, a general rate hike before they do that. We'll see. So then you've got the deposit facility rate in Europe. You want to be kind of paying attention to that interest rate decision. The US is doing incredibly well, but not everyone else is. So I think it is worthwhile for us to look at how non-US other countries are performing and if they're doing okay or not. Their interest rate is at 4.5. We'll see what they want to do with it, and we'll look at everything else in the US is fine. Then we've got GDP out of the UK and production. I'll be having a look at those things to see, because apparently, similar to New Zealand, the UK is also supposed to be in some form of a recession. And again, a recession is really when people aren't spending. So if you've got your corporations saying record profits, but you've got people not spending, that's because of corporate price gouging. It's just that simple. Excuse me. Sorry, don't need to blow my nose right in the ear. I apologize for you. So that's really the main stuff that's coming out this week. Just be prepared that if you're trading on the lower time frames, the 5 minute, the 15 minutes, or the sub 4 hour, most of these are likely to create some form of volatility, and just be aware of that. It means either if you want to take a trade ahead of this, that you maybe reduce your risk. Remember, ladies and gentlemen, you have 3 choices: buy, sell, or do nothing. Or another way of putting it is you could trade it at your full percent risk, you could trade it at a reduced percent risk, or you could demo trade it. If you still want to gain the experience, you can still do that. You still got those 3 different options if you want to do it. But never feel that that there's a gun to your head and you always have to trade at full risk, even if you have a bad feeling about the trade. You don't do that. If I start hitting big drawdowns, the very first thing I do is just dial down my risk. It keeps my headspace clear. And usually I get out of those drawdowns really quickly, because my trading isn't impacted. My emotions are not impacted by that. So I still think very clearly, and then I just get out of that. So that's my little bit of big brother advice to you guys in terms of mentoring. So there we go. So let's now go ahead and have a look at the charts. Let's go through and run through the charts and see kind of what's going on here. For the purposes of keeping it simple, I have got a simple moving average, 50 period, and a 20. Okay, so I've got these 2 here for straightforward reasons. Generally speaking, if price is above the 50, it's bullish. Generally, if it's below the 50, it's bearish. Obviously, we can look at the actual price action structure: higher lows, higher highs, or lower highs, lower lows. And also, if it's trending really well, it interacts with the 20 incredibly well. So I want to talk about that. And I've got the MACD here just to talk about the momentum. So is the market bullish or bearish? Is there divergence? Is there weakness in the markets? And so on. So let's run through the global indices first. Let's start off with the Dow. On the weekly, what can I say about this? Well, I can say that we've had an incredibly good run. I would say that the angle of momentum has changed. It's gone from really bullish this way to less bullish this way. Look, notice how many more wicks we have above and below. So the price action has been more jittery. It's stumbling effectively. And actually, it's become overextended. So here we're starting to see the very first corrections, potentially for price to come back to the 20-period moving average, or possibly to come back to the previous highs. So there are really, what it comes down to is which price level is it going to retrace to? Is it going to be an incredibly shallow price retracement? Is it just going to come back in here to, if we measure a Fibonacci measurement from these lows up to the highs here, you can see that they very similarly sort of overlap. You've got a 23.6 here. You've got a 382 at this next support resistance level. You've got the 50 fib close to this level and the 618 close to this level. So it's really more a question of how far back or how far is that retracement going to be. And so that's something that we have to be prepared for. What I'll be looking for is going to be a green weekly candle at one of these levels, a green weekly candle. We might get a green weekly candle here and then price drops further. That can happen because sometimes, just like us, the buyers or the bulls go, oh, this is how it's setting up. And so it's not just us. There are even institutional traders who think, okay, this is going to be the turnaround point, and then it starts and then it fails, and then this becomes the turnaround point and it keeps going. We are in a bull market. So the market is going to continue to the upside. The question really becomes, how far is the retracement? Are we going to get a short retracement now, and then we're going to get another correction down the line, or are we going to get a much bigger retracement now that lasts a couple of months, and then we're going to finish up the year nice and bullishly? It's really going to be a question of that. Let's look at the S&P. S&P's had an incredibly good run. If you look at the past, we do need a retracement. We are very much far away from the moving averages. We do need to have that. If you look at it from a monthly perspective, we also need to potentially have that. Look at the angle of price action here. Let me just lighten this up so that it's easier to see. Look at the angle of price action here versus the angle here. This is actually a lot steeper, which makes it more difficult to sustain. It is less sustainable. The steeper it is, just the less sustainable it is. And often when it does have a correction, it's a bigger correction. So where could we correct to? We could pull back to these highs. We could pull back to these highs here. We could possibly pull back here. Let's take a look at the, let's take a look at Fib. So all I'm doing here is I'm using multiple, whoopsie, that is definitely not a Fibonacci retracement. Up to there, and you can see the 382 pulls back here, the 618 is down here. So any kind of a pullback into this area, this is what we call the sweet spot. Anywhere from the 3 to the 618, anywhere in that area is a very healthy retracement, guys. It might seem scary if people are talking about how the stock markets are having a deep correction. I don't want you to listen to the language they use, the people who talk about that stuff and who post that kind of content. I'm not talking about our traders. I'm talking about the JP Morgan PR departments and the people who provide stuff to CNBC. It's not meant for us. It's meant for the people on the street, and it's garbage for the most part, because if it goes down one day, they'll be very dramatic. And if it goes up the very next day, they'll just change their tune and go, wow, it's all recovered. So they're not, their job is to just put out content. And so they will just maximize and squeeze whatever they can. So learn not to take that stuff seriously, okay? It's very liberating to not take their opinions, because their opinions don't actually matter. At the end of the day, the only person's opinion whose opinion matters is yours. And you might not feel confident yet, but there will come a day when you will find that your analysis ahead of time is actually starting to match up with other traders that you respect. In other words, your skills have started to catch up. And I just want you to remember, again, at those times, your opinion will start to matter. You have to build up confidence in your own analysis. So that's what's going on there. Let's look at NASDAQ. To stumble. So the question really remains, we know we're likely to have a retracement. The question is it going to be a very small one, or is it going to be a deeper one? A deeper one is better for us, because when it has a deeper correction like this, it has recharged its batteries, and it can do a bigger move the next time it takes a leg up. Excuse me. Is there another way that it can unfold? There's not an unlimited number of ways this can unfold. It can consolidate. So price action could go sideways for a month or two while the moving averages catch up to it, and then it could continue up. That is a possibility as well. But that's pretty much it. We've had a big run. We're due for a correction. It's really just a question of that. Then we look at the UK. The UK is sitting here, breaking through almost at all-time highs up here. So it's very nice and bullish. And as I said, we're in a bull market. We've been through, let's just zoom out a bit here. We had COVID, which was a big correction. So you can go all the way back here to post the 2007, 2009 global financial crisis. Also, I'm just going to say at this time, if you have not watched The Big Short movie, you need to. It is not just one of the most brilliant films ever. It is very entertaining. It's just outstanding. If you haven't seen it, most people who watch it like 5 times because it's such a great film, but it's very educating. It's very enlightening. So the global financial crisis finishes and the market recovers. We have the presidential year, which is basically kind of sort of what we're going through this year. The market goes through consolidation, then takes off again. We have COVID, which is a big correction. So in other words, this is the bull run after the 2007, 2009 global financial crisis. We finally have a bit of a correction, call it almost 10 years later, and then we have a bear market. Okay, so in other words, the reason I'm telling you this is we have had basically 2 very big sort of corrections in the market within a space of like 4 years, which basically means we're due for a proper bull market now, which means if this bull market follows previous bull markets, we have somewhere between 5 and 10 years of the markets continuing to go up. We will have retracements on the weekly, but in other words, we should be bullish for 5, 10 years potentially. Okay, the only concern I have is the angle of it is much steeper here than it has been in the past, and it's not sustainable. So we might find that the shape of the markets will change, the structure. We will have strict moves up, then big retracements, then strict moves up, then big retracements. That might change as opposed to a slow and steady. But the overall bullishness of the market shouldn't change. Okay, so let's move across and look at the Nikkei. The Nikkei also, look at that angle, has changed. It's very bullish. If you look at previous moves, it's now looking very steep, That also needs to have a little bit of a correction. So we need to see this come back into potentially as far back. What would be amazing would be a break and a retest of this level, but it doesn't have to do that. As soon as it gets back to about the 20-period moving average on the weekly, or potentially the 50-period moving average, it's actually done enough. It's what's like what we would call an organic trend line. Okay, so that looks really good. We've got the EU also due for a bit of a correction, our first really red candle after a very long period. So this is kind of what I'm saying to you is if you find the markets go sideways for the next couple of months or have a bit of a correction, it's part of the normal breathing out and breathing in. Okay, so remember the market can either go up, down, or sideways. Those are the only three things it can do. And for people in the markets, you can either buy, sell, or do nothing. Those are the only three outputs. It doesn't matter what the inputs are. It doesn't matter if it's a tsunami or a riot or a military coup. All the inputs always get to a point where the only thing that you could do is buy, sell, or do nothing. So the outputs limit what the market can do. It doesn't matter what all the inputs are. It can be anything. But you'd be amazed how often there isn't anything new that's ever happened. We've had military coups, we've had tsunamis, we've had wars break out. None of those are really that original. Okay. And so that kind of limits stuff as you go. Does this make sense? Is everything I'm saying kind of making sense to you guys? So just be prepared for the markets to become a little bit choppy. Part of the reason they are choppy is because there's lots of people who are still buying. As soon as this comes down to these levels, buyers are buying. But the difference is that the market might be running out of buyers. So the buyers are coming in, push it up a bit, but then it falls a bit, then it goes up a bit and it falls a bit. Because what's happening now is it's just running out of steam. It needs to take a break. It needs to take a bit of a breather, and it's normal. And that's why what gives you perspective is the weekly or monthly. That really gives you a sense of perspective. Am I close to the moving averages? Because that really tells you how far the market could drop, and still be an incredibly healthy pullback. It gives you perspective. That's a little bit of a secret sauce thing there. It tells you this is normal. The media will come up with all kinds of excuses because they kind of go, okay, why is it dropping today? And then often they'll just link it to whatever they can think of. So again, the media, if you haven't tried this, you should try 1 month without any media exposure while you trade. It's incredibly liberating and you'll realize how much garbage there really is out there. Okay, now, and that's not the same as fundamental analysis. Fundamental analysis might be like, what are the central banks doing with interest rates? Interest rates are like the single biggest driver of moving the markets that exist out there. But that stuff doesn't require that you read a JP Morgan article. It doesn't. You just need to know what the numbers are and you can work it from there. And there are some amazing fundamental analysts within the Actions to Wealth group, some really, really great guys, as well as technical. I know what the fundamentals mean, but I don't use them. I use technicals to make my decision. And that's a personal, everybody finds their personal groove, your comfort zone, where you're like, yeah, I don't need that information. It doesn't benefit, it hasn't changed my trading. I still get the results that I get. Just to kind of, here's one of the accounts that I manage so that you can kind of see how it's been. I'll just go through, just to give you kind of a return here. You can see the monthly stuff. So I'm up already almost 4% for April. March, the markets for me didn't really move. So that could be the market slowing down a little bit. January was big, but only because my losing trades got stopped out. During November, December, the markets went nowhere. The losing trades, the stop loss gets hit first, and then the winning trades, the profits are much further away. So the profits from the winning trades from November, December actually only came through in January. So don't be misled by that. It wasn't like I'm a superstar. It just happened that way. And you can kind of see where we are now. So I really like this because we've kind of 90% return on this account, nice and steady. And you can see compounding starting to take effect here. So I'm really optimistic about 2024. It's really good. And I want you guys to understand why we're in a bull market. And so we just need to kind of look and see how non-US countries are doing. Look at the ASX here. You can see it's starting to stumble. Very nice move. Then it starts to produce wobbles. So it's also running out of steam a little bit here. But overall, again, it's all-time highs. Looks really good. And again, yes, the stock market doesn't truly represents the entire economy. It doesn't. In a way, the stock market is pension money and investment money and spare cash, but it also does impact the market. It gives companies cash to expand and to do certain things. I guess what I'm saying is I take it seriously, but I don't. It's not saving lives. This industry is not a life-saving industry. So we kind of want to maintain perspective on how we use it as a tool to increase our personal wealth. Okay. That's all. We maintain perspective on everything. Now, this is interesting. So have a look here at the Nikkei. The Nikkei's had an incredible run. The angle, again, please look at the angle here. So this is the kind of degree angle there. Then this one is not looking so bad, but it's become a lot, the angle has started to become more steep. It's still nice and bullish, but when we have a correction like this, we're likely to see a correction down into kind of towards that area. It makes a lot of sense that we would do that. And part of that is that you get a move up and a stumble, and then it tries again and immediately stumbles again. So it's definitely running out of steam. That looks good. And then I want to show you the Hong Kong one. So I'm looking at this because I think that here we might be forming a bit of a double bottom. It's too soon to confirm that. We need to start breaching this downward sloping trend line so that the bearish momentum here starts to get broken. And also with China's 50, I also think there's a possibility here we're starting to see that angle of momentum, especially combined with that bullish divergence. We could start to see China's index starting to move higher, which is a bit of a lag, but it supports the idea that if we're on the early stages of a 5 to 10 year bull market, they are starting to turn around and catch up. That's all I wanted to show you on that one. Right. Let's have a look at crude oil. So crude oil is still performing incredibly well, guys. Still performing well. It's above the 50 period moving average over here. So it's bullish. That's obvious. We could see there was a strong level of support here that held. And actually, I just do this just for fun. Just if you kind of draw a line that runs along here, you can see we started to breach. If you just think of that as a line in the sand, if it stays below this, it's weak, but it's starting to push through that. So that implies oil starting to strengthen. And if you look at the daily, beautiful quality. I want you to pay attention, guys, to the quality of the price action behavior. It's a nice quality trend so far. It's stable. It's not too choppy, or at least it's becoming less choppy now than it is over there. So here we could do with a bit of a retracement, potentially where would that retracement come back down to, possibly kind of down into this area. I mean, that's a relatively deep retracement, but again, the shallowest would probably be to sort of this area over here. So you kind of possibly have an $83, $50, $84 kind of pullback there, and then looking for some green candles to take that to the upside. So for now, my expectation is that crude oil's got some room to move to the upside. It's got plenty of, it can head all the way up to here. So it should provide some high probability, relatively safe trading opportunities on that. So I like the look of that. This is Brent. So Brent is so similar. I think that the two most correlated constituents on this chart are Brent oil, UK oil, and US oil. I think that their correlation, I don't know the exact amount, but it's very high. It's like 97% or something stupid. So therefore, for me, it's a personal choice. I just trade one of them. They are just too highly correlated for it to be two different things for me. Whereas, for example, dollar yen and euro yen and pound yen are more like 75% correlated, and you might get a better run out of the pound yen, or you might get a better run out of dollar yen. The correlation is loose enough, it's there enough to tell you there's a trend, but the outcomes can vary. So I prefer that as well. But yeah, with US oil or Brent, no difference to me. That's a personal opinion on that one. I'm quite happy to say if it's a subjective opinion or if it's more objective. Let's have a look at gold. So crude oil is very good, higher on the list. Gold, obviously, absolutely crazy at the moment. Again, please have a look at the general bullishness kind of over there. Then you can see the angle kind of over here, and now you can see the angle here. It's starting to kind of go almost parabolic. And so when it does have a correction, I would expect it to, if we go especially to the weekly, then we could have a deeper correction sort of towards these levels here. It could happen. So just be cautious with this, okay? Just be cautious with that, because it's going to run out of steam at some point, and we would expect it to have a bit of a pullback. It looks really good, but there's no doubt in my mind that it's certainly overextended for the time being. from the moving averages on the weekly as well, on the daily. It's had a really good run. So very, very cautious. It means that I would probably prefer a bigger pullback if I was going to take a trade on the daily. If I was going to take a trade on the intraday timeframes, I would probably reduce my risk and definitely make sure that I'm taking partial profits at 2-to-1 or 3-to-1. Absolutely. Because at some point, I would expect this to start kind of slipping. And one of the clues would be, again, if it starts to drop below some of these kind of trend lines, if it starts to have a bit of a correction there, okay, I'd be a little bit more cautious about that. Take this a little bit, kind of just put a couple of these lines in here, because once it starts to breach them, then you know there's a bit of an issue. And even go like this would also be a clue. So those kind of just give you some angles where you're like, okay, if we start to breach through these, we start to drop below that 50-period moving average, we're becoming more bearish. Those are kind of your first clues there. And definitely in a situation like this, you would never move your stop loss or increase your risk, because we know that there's going to be a correction that's going to come, and it could be a really big one. So if you're getting it on the lower time frame, you could put your entire account at risk if you have to move your stop loss and this decides to drop a couple of 100 points. So in this situation, you want to probably reduce your risk and make sure that if it does, put your stop loss, if you want to put it a little bit wider, but if it gets hit, let it get hit, you know. And the beauty of position sizing, ladies and gentlemen, is that no matter where you put your stop loss, that's a separate calculation to how much you risk. You could put your stop loss over here and risk 1%, or put your stop loss here and still risk 1%. That's what position sizing is. So you always do the both. You always decide, okay, where do I want to put my stop loss first, geographically on the chart, and then how much can I emotionally and financially can I afford to lose, or will I accept losing? Will I accept losing if that gets hit? Those are all very much headspace things. All right, now, let's go through the currency pairs, and I realize we've been running for 27 minutes, but I hope you're getting enough value from this that you're okay with me doing this. I'll try and do this in 10-15 minutes and not keep you too long. Okay, so what can we say about this? Well, the euro-dollar 4-hour has turned bullish. I mean, I'm a little bit cautious here. Let's just draw a line across there. So I haven't quite broken through it, but we have come up above the 50 period, pull back down. The 50 and 20 have turned bullish, and we produced a bullish candle here. What does it mean? It means that there is a fair possibility that this could be the higher low. So the market could go higher on Monday. We'll have to see if that's the case. How's the MACD doing? It's not bullish yet, but it's not super bearish. So we'll see how that's going to be the case. Let's look at the daily. Let's have a look at that. We've got potentially higher low over here. Let's keep an eye on, I would keep an eye on these, on this kind of thing, because once we breach that, we're likely to see it head high. You can see Thursday and Friday producing kind of range-bound types of behavior, but that 4-hour looks more bullish than bearish. Just a thought, looks a little bit more bullish than bearish. Let's look at sterling. Sterling starting potentially to produce a very messy upside down head and shoulders. What do I mean when I say that? You could see here that you've got a little bit of a downward trend, but you've got a higher low here. And usually that means that at some point here, there's the head and it's potentially going to produce, it's a very messy example of it, but there's your neckline and it's going to go and do that. A head and shoulders pattern, ladies and gentlemen, is just a change in trend. It's just a change from an uptrend to a downtrend, or a downtrend to an uptrend. So usually if you can see the trend is changing, there's probably a left shoulder and a head and a right shoulder somewhere there. Okay, it's an oversimplification, but the longer you do this, the more everything just merges together. Head and shoulders, bear flags, bull flags are just changes in price action trend. They all just become the same. Ascending triangles, descending triangles, pennants are just all the same thing, actually. That's a nice feeling. After a while, when they all look the same to you, you feel like Neo at the end of the first Matrix movie, where he just sees the code and he sees right through all the different things, which is obviously what you want to be doing. You want to get to a place where you pay attention to the price action first and your key price levels, and the other stuff doesn't distract you too much. Aussie dollar, US dollar almost certainly looks bullish. I know I'm on a 4-hour here, but the 4-hour is going to produce. Let's talk about it like this. We've got 5 days next week. Very few of us are going to be doing 12 hours in front of the charts, probably more like 8 hours, which is 2 4-hour candles. maybe 3 4-hour candles. So let's say we're all going to do 12 hours next week. That's 3 4-hour candles. That's 12 4-hour candles. That's it. That means your entire trading next week is going to take place between 12 4-hour candles, but probably more like 8 4-hour candles. That's not a lot. So we can actually use the 4-hour here to get a sense of what we think the next 8 candles are likely to do. Does this make sense? And so what happens is you're going, well, this almost certainly looks like a break and a retest. We have lower lows here. We've definitely got bullish divergence on this. So it would appear as though price has started to go higher. The 50 and the 20 have shifted into bullish mode. Price has pulled back to the 20 and produced a strong bullish candle. The next, it's not guaranteed, but the next most likely direction the markets are going to go is up here based on this behavior. The only way that won't happen is if the markets on Mondays suddenly reverse again. And that sometimes happens. Mondays are funny days. So Fridays it sets up to go long on the Monday, but then Monday it just reverses and goes the other way. That can happen. If you find that on Monday this drops all the way back down to here, then that's what's happened. And then you just want to like reset and just see what else is going on. But if on Monday you find this just immediately goes up, and on the euro, the dollar, on the euro, the pound, and the Aussie dollar just breaks above the highs, it's pretty much confirming everything that we've spoken about here. Okay, excuse me, I'm just going to blow my nose again, and you don't need to be subject to that. Okay, so Kiwi dollar. So these are all US dollar things. Look at this, beautiful. So we had this really amazing downward sloping trend. Price breaks above the 50, pulls back, produces the bullish candle, 50 and 20 in a bullish formation. And there's absolutely no doubt we have bullish divergence or bullish momentum on the MACD. In isolation, if I saw this 80 times out of 100, at least, this is a sign to go long. So there are some potential long opportunities here. You have a couple of different options. Again, if you're using the Wave Rider, that's all fine. Just follow the Wave Rider stuff. But for example, here, yes, I might put my stop loss under here. I might put my stop loss under here. And my entry might be above the high, for example. And where do I think it's got the potential to go to? Up here, which makes this a potential 3-to-1 trading opportunity. That's just a concept. Okay, that's just the idea. That's a potential. So just wanted to kind of draw your attention to that. If it is indeed going to turn around. Looks good. Dollar Swissy. Dollar Swissy starting to stumble a bit. There's a level of support. We could see again, it's a very choppy, messy head and shoulders pattern. That could be the head. We could be forming this and then we end up changing trend. So again, it's starting to slip below the 50-period moving average. And we could see it start to do this, possibly. We'll see. Again, Dollar Swissy kind of does its own thing. Dollar Swissy, dollar yen, dollar CAD. I usually find that the euro, the pound, the Aussie, and the Kiwi tend generally to be more kind of generally follow each other a lot more. I find dollar Swissy and dollar CAD are kind of doing their own thing here. Dollar CAD looks like it's trying to go up, but it's very choppy. Look at this. This is just garbage. This is incredible garbage. And this is where you might say, you know, somebody might say, well, but what about crude oil and the correlation between dollar CAD and crude oil? I'm going, that doesn't really matter because right now it's very choppy and incredibly volatile and it doesn't have a good quality trend. So I wouldn't trade this. Even if I can see it slipping a little bit higher, the quality of the price action structure, in other words, the personality of it, is very schizophrenic. It's very kind of volatile and unstable, and therefore I wouldn't trade it. Okay. It's kind of like when someone says, you know, gold is a hedge against inflation, and then you see gold going down and inflation's going up, and that doesn't really make sense. If inflation's going up, what's supposed to happen is that gold should also go up, but it doesn't. Why? Because during periods of inflation, it's a myth, it's not true. The market goes towards the US dollar because it feels safe with the US dollar. The US dollar gets stronger, which keeps gold down. So there are myths like that that exist. And if you're not seeing that correlation with your own two eyes, it isn't there. So just a very important reminder. Dollar Sing is looking good. I think this is very similar to the dollar index. I think it is looking nice and strong, but it's battling with a bit of level here. So it might get knocked back a bit. It might break through. I'd keep an eye on that. If it breaks through here, it's got some good room to move to the upside. And I think that would be supported by that stronger US dollar. So I'd look at Dollar Sing and I'd look at Euro dollar and Pound dollar. Because if this goes through and the dollar and euro and GBP go down, that's the dollar getting strong again. But if we see this go down and we see euro go up and pound go up, then the dollar is getting weaker. Let's look at dollar yen. So dollar yen, remember that dollar yen, this is a very interesting one. I want to spend a couple of minutes talking about this. Bank of Japan have raised interest rates by a small amount, but for the first time in like 20 or 30 years, very long period of time. And they don't want the yen to continue to weaken. But the main trading partner they care about is the US. That's their biggest export trading partner. So the first thing they're really doing is they're trying to fix their economy and do it around the dollar yen as well. I don't think they want this to keep going higher. So there is, there's potential for them to intervene or do stuff. It makes it slightly higher risk to trade. But the reality is that when you look at the yen pairs, the momentum is still currently bullish. It still wants to go higher. So what do? This is one of those rare moments where the fundamentals probably need to be paid attention to, even if you're purely a technical trader. You need to know that the Bank of Japan might start intervening or pushing it or trying to get it to go the other way. We don't know yet if their policies are going to kick in. Basically, if they make enough changes on the policies, then the appeal of a weakening yen will go away, and then potentially it'll start strengthening. The problem is that we're sitting in that space in time where the existing trend hasn't quite died and the new policies haven't quite changed the trend yet. So it's not quite clear what it wants to do. It could go up for a few more months and then start to turn around, or it could start faltering now and then change around. So for me as a trader, it means I'm going to risk less. And in other words, instead of 1% per trade, I'm risking 0.25% per trade or something. It means I'm also going to have I'll potentially watch price action and be prepared for it to suddenly falter. So if I find that all of a sudden it just can't go any further and it comes back and starts breaking these lows, and it should normally be doing that, it's probably because of the policy changes. So just be aware of what's going on there. They don't, in the long run, they really want to curb this trend and they want to kind of turn around, but it could take them a year to do that. It could take them a month. It becomes very unpredictable. So just be cautious that if you see a setup that's really nice and bullish and you want to take it, just be aware that if you take it at a full 1% or 2%, whatever your existing risk management plan is, and it fumbles, that's all. Just be conscious that there was a risk and you took it anyway. That's not a criticism. That's saying that when we take a trade where the risk has increased, we just need to, in our journal, acknowledge that we knew there was a risk and we were happy to still kind of take the trade. Alternatively, you say, well, the risk is there, but the setup looks really good. I'm going to go in and take 0.5%. And then if I hit my target, great. And if it fumbles and it's a losing trade, then it's fine. I took that into account. I mitigated the risk by going at 0.5%. It's just about consciously acknowledging what the risks are. That's your job as a trader, is to learn to be objective when you're looking at a trade setup. So that means acknowledging the risks, whether you like them or not, is just to acknowledge them. You'll find that over time, by learning to acknowledge the risks, you take them into account. And if the trade goes your way, you still win. And if it goes against you, you lose less. You still come out a better trader. So anyway, Kiwi yen, just be aware of all these. Just be aware of all these things. Okay, they still look bullish, but they're also still fumbling a bit. It's odd. Sing yen. Also, this to me, guys, if you follow my stuff, this looks that's a buy setup, but I'm still cautious. It's a buy setup. There's a clear level of support. It still looks like a buy setup, but I wouldn't risk a full 1% on this, and I would definitely target 3-to-1 on that. So, it's possibly even a wave rider setup. Let's go have a look here. Where's my wave rider stuff? There we go. So what is Sing Yen? Come on. Did I crash MT4? We're almost done, guys. Another 5 minutes and we're done. I think I might have broken MT4. It's finally warm enough here in the UK that we don't have to have the heating on. This is the first time. So there we go. It looks like a wave rider setup to me, depending on your kind of how you use it. So it's a very similar setup. Okay, so just, that's a setup, but just think about how you want that to be the case. Let's go through the Aussie pairs. So the Aussie pairs are looking nice and bullish here at the moment. Aussie, Swissy. For me, I'm going to run through the Swissy pairs quickly. I think the Swissy pairs represent some of the best opportunities over the coming months. Let me make my case to you. So dollar Swissy, let's go back to the longer term timeframes, has started to produce very bullish actions here. There's bullish divergence here. We've got bigger moves. Look at the distance prices over the 50-period moving average versus in the past. It's started to breach these downward sloping lines. It's doing more bullish stuff than bearish. It is stumbling a little bit where it is now. I concede that. But then you look at Euro Swissy. Euro Swissy is also, again, look at the bullish divergence here. Also breaching up, also running out of steam a bit, but that's okay. It's had a big run up, but it's shifting more to spending more time above the 50-period moving average. So this is where I look for things like come down and then bounce on that 50-period moving average. And it's just looking more bullish and bearish. We'll see. Then we've got pound Swissy, also starting to do big moves above that. It's further above the 50-period moving average than it has been in the past. That looks pretty good. Let's look at Kiwi Swissy. Kiwi Swissy is not the same, and the main reason for this is that Kiwi itself is quite strong in this sense, so that the two are kind of countering each other out. Or I should say weak. The Swissy's weak, which is why everything else is going up. Kiwi's also weak, which is why it's taking that. But then we have things like Aussie Swissy, also looking nice and bullish. Look at this beautiful triple bottom base, bullish divergence, breaking above the 50-period moving average. I just think you guys should look at the Swissy pairs and see if you think that they look bullish as well. CAD Swissy. So Aussie Kiwi, let's just have a look. That's had a long run up. At some point, that needs to do a bit of a retracement. We'll see if that's going to do that. From a daily perspective, it's just been a straight up move. Aussie Sing finally broken out of this consolidation. So Aussie pair is looking pretty good there. CAD Swissy, also nice and bullish. Look at this pullback. So there should be a wave rider set up here in the coming days. Okay, nice trend. General Swissy pairs looking nice and bullish. There should be a nice setup that happens there. Euro Aussie, very choppy. It looks like it's slightly starting to break down now, but just I'm cautious on that one. Euro CAD, still within a range, in my opinion, still within a range. So I would wait for it to break out before I'd start looking at any setups. Doesn't look great. Euro GBP also kind of formed a bit of a strong bottom here, starting to look more bullish, absolutely, but just not a great trender. It's not a great trender. Euro Kiwi, potential setup, possible wave rider setup here. We'll have a look and see. This looks like a bit of a battlefield for it to get through, so a bit cautious there. But once it gets through that, it'll have a nice move to the upside there. So there's a possible wave rider setup there, we'll see. Euro Sing, just Euro Sing, garbage, just too choppy, too sideways, not a fan of that. Pound Aussie, also sort of starting to break down. It might start trending lower, but overall cautious about this one. I'll keep an eye on it. Pound CAD, again, it's producing higher lows, but it's doing big wild swings. It's not a great trend compared to what we've seen here. This is great for day trading. This is great for swing trading. This is just all over the place, but it is bullish. It is bullish. You can see it's starting to break through these, starting to look more and more bullish. Pound Kiwi, also possible setup here, guys. Wave rider setup here. What do we like about it? Support resistance levels, uptrend, double bottom. That's one potentially worth considering. Kiwi CAD, last one. Also again, not a big fan of this. Like Aussie CAD, it's got big swings, big wild one. The CAD crosses don't look as attractive to me at this time. Swissy crosses look great. Some of the Kiwi crosses look good because the Kiwi's nice and weak. Some of the yen crosses with a bit of caution. Dollar pairs also. There's lots of stuff going on, lots of things to have a look at. How about pound yen, please? Yeah, again, look at this. So level supports, and I'm drawing it off this price action here. Test is there, test is there. Excuse me. Even arguably, it's closing above that. That's a buy setup. That'll be a setup. My only concern is the general yen bank policy. That's my only concern. So they are setups. They are bullish. I just don't. This is a personal choice that you guys need to make. Personal choice. And there's no judgment that comes attached to this. This is a massive learning experience. Every trade you take, ladies and gentlemen, is training for the next trade. If you're Tiger Woods or some sports athlete that you admire, everything you do is to get you better for the next time. Okay, it's just a continual training or learning kind of edge thing. That's what it is. You have to decide. This is a setup which is separate from do I want to take it? It is also separate from, but what are the risks? This is bullish. There's no doubt this is bullish. But there's also the Bank of Japan are trying to kind of turn things around. Is that turnaround going to happen this week, or is it going to take 6 months? That actually, I don't know. Maybe, there's traders better than me that could tell you for sure, no, it's going to be this week. I don't know that. In my experience, it's the timing of this, of fundamentals, is actually the trickiest part to predict. This could very well do a 3-to-1 or a 2-to-1 and then fumble. So that's where that cautious is, yeah. Okay, so it's a personal choice, and that's why I say there's no judgment. For example, if Paul was listening in on this, and Paul obviously cares about you guys not hurting yourselves, he would be like, I just want to know that you know all the risks and that you took those into account when you placed the trade. As long as you knew them, if you decided to go at full 1%, that's fine. But as long as you said, these are the risks, these are the dangers. That's really what's important. It's okay if you said, I know the risks and I'm still going to go 1% and you lose money. That is actually still okay. The most important part of that process is I knew what the risks were. Like it's not a judgment thing. We don't think less of you if you guys. It would be crazy, for example, if you said, I know the risk, but I'm going to go in at 5% risk on this trade. Like that would be silly. But if you just decided, I have a budget of 1% per trade. I understand the risks. I'm still willing to, on this one trade, I'm still willing to use the full budget. That's a very normal, rational type of behavior, okay? So I want you guys to understand that what we're trying to do here is to instill in you the ability for you to actually make decisions without us. And sometimes they're going to be mistakes, and that's okay. Because the only way we got to where we are now was to go through the only way you can do it is to make mistakes. You just want the mistakes to cost you as little as possible. But you will make mistakes, but you'll make fewer of them as you go on. And then you won't even see them as mistakes. You'll just see them as like, okay, in that situation, I like price action, maybe we're not even talking about Bank of Japan. Maybe it's at a major level and you're like, it looks a bit overextended. It might the trend, I think the trend is looking like a beautiful setup, but it's overextended on the high time frame. So maybe it's going to do this instead, but I still want to take the trade. I'll put my stop loss here. And if it does fail, maybe I get a break-even trade. Like that's the kind of stuff that's going to happen to you. And you're going to go, you know what? I'm still going to take the trade. And the kind of thing that happens is, imagine this was pound yen and there was Aussie yen as well. So you took both pound yen and Aussie yen climbed and hit your 3-to-1 and pound yen failed and you had a break-even or a losing trade. That happens. And that's perfectly okay. What we look at is, how did you rationalize making the decision and how did you manage the trade, whether it went your way or went against you? Because those are habits. Everything you do here is just building habits all the time. Okay, guys, thank you so much for your time. I always appreciate it and I love chatting to you guys. I know I don't do these very often, and I hope for those of you that I did see in Bali, it was really great meeting you all. I had such a great time. Thank you. You're all stars. And yeah, look, fantastic trading this week. Enjoy yourselves. We're not saving lives here. We're making money. It's okay. And we do net profits. Take 10 trades, have 4 losers, but have 5 winners. That's okay. Ladies and gents, thank you very much. I'm going to head out now and I will see you guys. Enjoy what's left of your weekend and your Sunday and have a great week. Okay, guys.